Good afternoon. Today is Friday, the 3rd of August, 2012, and this is Brian Shannon from AlphaTrends.net. We had a real wild week here again as this market continues to show a tremendous amount of volatility, and the S&P 500 did close up for the day. In fact, the Russell 2000 continues to be the laggard here. You can see it was down 1.2% this week. Gold lost some ground, as did the U.S. dollar and bonds. So let's take a look at this market here and what we have. Let's take a look at the S&P 500 first. We do still have an uptrend here intact, and that uptrend trend has not been broken in the S&P 500. So we've been talking about the higher highs and higher lows in here, and we continue to see that pattern exists on the S&P 500 daily chart, where we see these higher highs and the higher lows. So the most recent pullback this week did get us down towards that midpoint of this recent range, and obviously today's gap made it difficult to take advantage of that, because coming into today we were below a declining 5-day moving average. What I was thinking was a likely scenario for today was maybe a little bit of a rally early on and then to continue lower. Instead, we had another gap higher above the 5-day moving average, and we've spoken about that several times, that these gaps above the 5-day moving average seem to be taking away a lot of the opportunity to trade this S&P 500. So we've got an uptrend intact. It's not an easy one to trade though, and we've got still mixed messages from the Russell 2000, as we'll see. But the message here of the S&P 500 is still on the daily time frame, higher highs and higher lows with a rising 10, 20, and 50-day moving average. The weekly time frame, looks like we're headed for the highs. Really, I mean, it's difficult to think that we that these aren't reasonable expectations for us to get back up towards 140, 142 in the SPY over the coming weeks here. Maybe Friday or Monday rather, we get a little bit of a pullback down towards this prior important level in here near about the 138 and a quarter level. If we pull back down towards there in that 5-day moving average, then I would think it's probably going to be a purchase opportunity. As a lot of people got stuck short, I think, on Friday, expecting a bad jobs number today, and we had broken below that 5-day moving average and that sort of thing. But obviously, we got a big squeeze here today, up almost 2% in the S&P and in the Nasdaq. And the Nasdaq broke some important resistance. We've been talking about this 65 level in here as it's been, the S&P, or I'm sorry, the Nasdaq is also been in an uptrend, although not as pronounced as the SPY. We do see that that this uptrend of higher highs and higher lows has emerged or continued since the June low, and today we broke an important resistance level at that 65 level. So 65 should be an important level of support in that area early next week. Otherwise, it looks like it's heading up probably at least towards 66 and a half. When we look at the 10-minute time frame, we do still have a rising 5-day moving average. So 65 is going to be the important level to watch early next week. The Russell 2000, here again, this is what we've been talking about. We've been talking about the pattern of these lower highs and these lower lows. Well, this week we came within 8 pennies of this low right here. I believe this was 76.23, and today we were at 76. Or I'm sorry, 2 days ago we were at 76.31. So we didn't make a lower low. We got down to an important support level and found support there, and then got this big bounce gap and bounce higher today. In order for this to really turn around, it's got to get back up above the 80 level. At that point, we will have this higher low and then a higher high. So there still remains a real choppy environment, but it's improving for the Russell 2000. That part is clear that it's improving, and then we've got this trend line also in about that 80 level. So the Russell 2000 continues to be something that 78 has been an important level back and forth, 77 and 75 to 78. We've been up above and below that level. It looked like we were headed just below 76, but obviously the gap changed that. And then when you have this type of gap activity, unless you're really willing to chase, you have that. Well, let's take a look at it from a 2-day chart. It gapped up and it did pull back below the volume weighted average price briefly, and then as it got back back up above, this is often a very good entry. As it gets back above the volume weighted average price, it really exploded higher from there. And we did close above the VWAP here at the end of the day. Generally speaking, I think that you want to do your day trades in the direction of the volume weighted average price, your swing trades in the direction of the 5-day moving average, and your longer term holds in the direction of the 50-day moving average is really, and then of course there is importance to the 200-day and that sort of thing, but that's more for longer term investors who don't view this video each week. The semiconductors, we've been talking about this level up here at 32.75 up to 33, how this is, to 33 and a dime really, how this has been a big prior level of support that turned into resistance, and so far we're still banging away at it. The 33, even up towards maybe 33 and a half. So the semiconductors made a heck of a turn here the last 2 weeks as that 29 and a half, 30 level was tested again, and we've just continued to explode higher. We didn't break support yesterday, and it looked like maybe it was starting to turn more neutral, and then perhaps there would be a short sale opportunity. And I think that this market also caught a lot of shorts off guard. And there are two types of shorts that I talk about. This, the short squeeze, two types of short squeezes. That is a knee-jerk short squeeze where something is in a downtrend and it experiences a bounce, or something more structural. And I think we're getting something a little bit more structural right now in the semiconductors because that 50-day moving average has flattened out, and we held above this key midpoint of that range as well. The financials were right up against that level we've been talking about as well, 1490. We hit that to the penny today. So 1490 has been the level we've been talking about, and it seems as though in here what we did have this little pattern of lower highs and lower lows. It turned itself around. We had the higher low on Thursday, and today we made a higher high. So it looks like to me that we get beyond that 15 level, that $15.25 looks like it's coming near term for these financial stocks, and you have to trade price, not headlines. Let's see, someone asked me to take a look at gold. I think gold is really kind of dead in here. We have this prior support in the GLD at about 158, and that prior support has acted as resistance here the last couple of weeks. We do have higher lows, last several weeks, and then you go, to a longer term time frame, like the weekly. You can see we're just sitting on this big important support level that if this breaks, I think it could be pretty tough for gold going forward. And we do have a declining 50, 100, 150, and 200. So I would say that gold is neutral at best. Changing it would be to get back above 160, 159. Getting above and holding above 159, I think, would change the look of gold for a bit. The bonds also, last week we talked about how, as they tested the 50-day moving average, that this isn't necessarily a top, but could be part of the topping process in here. We are still holding a rising 50-day moving average, and we are still holding this prior level of resistance. You could look at the 30-minute time frame, and what we'll see is we'll blow this up a little bit, and this little head and shoulders pattern will become a little bit more clear. So here's our shoulder, this head, and another shoulder, and you could make the argument that neckline has been broken at about 128. So if you're, if you don't mind going against the trend on the daily and the weekly time frame, there's a possibility that we could see some reversal in here, but it's not what I would consider to be a low risk trend alignment trade. In other words, we still have mixed messages from different time frames. I think the real thing that occurred this week that was kind of frustrating a little bit. By the way, this video is brought to you by Realtik. Realtik is the software we're looking at. It's where I do the trades, and they sponsor this video each Friday. So check out realtik.com. I was going to say though. What seemed earlier, or towards the midpoint of this week, it seemed as though we were just kind of dodging, not getting involved in a lot of stocks because they had looked like they were set up to continue, but for this ATRS, we were looking to buy it above this resistance here, but it just kept going down. We saw the same thing in this CLDX, that this is a stock that had a nice looking daily chart, and it just kept pulling back. It never gave us those reasons to buy. CMG is a broken stock. We were looking for a trade earlier in the week, we were looking for it to get above some resistance in that 5-day moving average. Instead, it continued lower. Today, obviously, it gapped a little bit higher, but this is a very dangerous non-trend stock. It was something we were looking at as a potential high risk bounce candidate, and I still think it's very high risk, not the normal type of trade. But missing entries in ESRX, for instance, we were watching it on this day. We didn't chase the gap. It was below the volume weighted average price and continued to get hit hard. So these types of stocks that we avoided and actually missed some really or got stopped out of what was it, IRIX, was it? No, it wasn't it. There was another one that we got stopped out of and took a small loss. Obviously, there was big news in this COG, but the KCG. The point is here on why are we looking at KCG? The 50-day moving average was already declining in KCG, and then of course we had the news about their algo gone wild. And news and surprises, not that I could have predicted this, but news and surprises tend to follow the direction of the trend. And the best way to look at that trend, I believe, is the direction of the 50-day moving average. Just a real quick thing to look at. Coach, for instance, Coach, we were talking about this a couple weeks ago. I was saying it's not probably my type of trade, but as it rallied up to the declining 50-day moving average, I thought it would fail. And sure enough, this week, it just got destroyed, probably on earnings. I didn't see what it was. IBM, on the other hand, had earnings a couple weeks ago, and we spoke about the declining 50-day moving average. Now what we have, though, is that 50-day moving average is flattening out, and IBM is breaking past some resistance. So IBM is looking a little bit better at this point as a turnaround candidate because we broke a downtrend line. We're above a rising 10-day moving average. That 10-day moving average is up through the 50, etc. Stocks, however, like CLNE, declining 50-day moving average. These are what I call knee-jerk short squeezes, that we have a stock in a primary downtrend and people get all excited about them because they have a good story. It happened numerous times with MCP. MCP, this is Molycorp, the rare earth play, and people got excited over here because it was up through the 50-day moving average, but the direction of that 50-day moving average is lower. And typically, if they don't scare you out on declines like this, they're going to wear you out like they do in a stock like Jeffries, JEF here, or in a stock like NBR, that you're going to get these little false starts, but then it's, after decline typically comes accumulation and then markup. It doesn't just go typically from, just turn itself completely around. It does happen on occasions, like in MELI. Now, we'll see if MELI holds, but this stock, there was no reason to own this prior to today unless you were betting on earnings or whatever the news was in here. But these rallies with a declining 50-day moving average will generally fail. And that's what happened on this occasion, and this occasion it would have been very painful. Now, had you bought over in here, well, was it luck or was it good timing? I don't know, but I'll leave that argument for somebody else. The point is, always be aware of what's the direction of the 50-day moving average and where is the stock in relationship to it. Hope everyone enjoys a good weekend and that this market settles down and doesn't gap so much and we get a little bit saner trading environment. So rest up and I'll talk to you next week. Thanks.